My pleasure to welcome John Mills.
Well, thank you very much, David, and thank you all for turning up at 8:30 in the morning. All the other launches I've ever done have been in the evening, but I was assured that 8:30 in the morning was a better time. I must say, I was never wholly convinced that was the case, but anyway, thank you all for turning up as early as this. Now, as you probably know, my day job isn't as an economist at all. It's running a business which buys and sells consumer products. And prior to that, I was involved in manufacturing in the UK for quite a long period of time. And it's always absolutely baffled me that the establishment in this country, most people believe it doesn't really matter how much you charge people for the goods you produce, they'll just go on buying them. And very evidently, they don't. And this is why the economy in the UK is in the, I think, really dire shape it is. And there are two particular factors about the British economy which I think really are, which presage very gloomily for the future. The first is that the amount of money that we're investing every year in our future has sunk down and down and down. And here are the numbers. For the first 3 quarters of last year, the proportion of our national income which we spent on investment was 13.5%. Now this compares with a world average of 23% and 46% in China. Now if you take off that 13.5% depreciation of existing assets, which comes to rather more than 11%, you're left with about 2.5% of GDP being invested in the future. But that barely covers, in fact it doesn't even quite cover the extra money that needs to be spent because our population is going up to stop all our national assets, that's roads, schools, buildings, hospitals, housing, from being diluted down. So the reality is that the net investment that we're making per head of the population in the UK now is 0. And this is the first time this has happened really since the Industrial Revolution started about 200 years ago. And if you are puzzled by the fact that productivity isn't going up at all in this country, the fact that there's no net investment might have really quite a lot to do with it. That's one problem. The second problem is that we simply do not have enough to sell to the rest of the world to pay our way. In 1970, we had about 1/3 of our national income coming from manufacturing. In the middle of the last century, by the way, it was about 50%. By now, it's now barely 10%. And if you look at what we sell to the rest of the world, some of it is services where actually we do have a competitive advantage, we do quite well. But still, the vast proportion of what we sell to the rest of the world are goods, and most of those are manufactured goods. And if you've only got 10% of your economy producing manufactured goods, you simply do not have enough to sell to the rest of the world to pay for the imports we want, and we finish up with endless balance of payments problems. And indeed, the last time we had a balance of payments surplus was in 1983, which is more than 30 years ago. So the balance of payments is a huge constraint. And if George Osborne or any other Chancellor of the Exchequer, Labour one as well, tried to reflate the economy in the present circumstances, with the exchange rate where it is at the moment, all that would happen is there'd be a big balance of payments crisis, the Bank of England would raise interest rates, and growth would grind to a halt. And this seems to me to be very likely to be what's going to happen. So the prospects for us going ahead are that we're likely to stagnate for year after year after year, a bit like Japan did after the crisis there in about 1990. And that really is a dismal prospect. And it's probably not so bad for people like us in this room here who are in fairly high income conditions in a city which is doing reasonably well. But it's a really dire prospect for most of the rest of the population who are in insecure jobs, being paid less than they were 5 or 6 years ago, with terrible job insecurity, and with very large levels of unemployment as well. Now, is all this necessary? The pamphlet that you've got in front of you there suggests that it really isn't, and that there is a solution to these problems which could be implemented either by a Labour government or a Conservative government or by a coalition. And what you have to do is this: you have to make what needs to be done to produce large increases in output in the short term really profitable. The problem at the moment is that most of the things that we most urgently need to do, which is to get more investment into manufacturing, to get more exporting, is so unprofitable that it just doesn't happen. What you need to do is to get the exchange rate down to a level which makes all these things really profitable. But if you do, all the evidence shows that you then get a huge surge of output as you bring together both new investment in manufacturing and big reductions in unemployment. And if you read through the pamphlet there are some examples of where this has happened, both in this country and in the United States in the past. But this is really what's happening all over the world, in countries which are developing rapidly, but particularly in China. The reason why the Chinese economy is growing as fast as it is because of the very high levels of investment in light industry, where the returns are highest, and the migration of large numbers of people from very low productivity agriculture to the industrial part of the economy. So it is possible to produce a big surge in output, and this is what we then need to do to make some really radical changes to the British economy. And the two really crucial ones are, first of all, that we have to get the rate of investment that we've got up from about 13 or 14% to around about 23%, which is the world average. And the second thing we need to do is to get manufacturing up from about 10% of GDP to somewhere around about 15%. If you look at countries right across the world, all the developed, diversified economies that have less than about 15% of their GDP come from manufacturing are in trouble. And what has been done in this pamphlet here, which I think is the first time, or I've never seen anybody else doing this, is to try and quantify all of this to see whether the numbers do in fact stack up. And there's a spreadsheet in the middle of this pamphlet which is crucial to the analysis which is there, which shows how it would be possible year after year to achieve the objectives that I think are really vitally important. And these are, first of all, to get the growth rate up to 4 or 5% per annum, which I'm sure is possible. Then to make sure that living standards rise at the same time, because otherwise this policy is just unsaleable. Thirdly, to shift the proportion of GDP over to manufacturing and to get the rate of investment up. And there is a big problem here, which is that if you're going to shift or you're going to change the composition of GDP the way that's required, so instead of having only 13 or 14% of our national income devoted to investment, it's going to go up to 23%. That's a 10% shift, which has to come from somewhere, and that would have to be out of consumption, other people's incomes. And what you need to do, therefore, is to have the economy growing fast enough to enable you both to have that shift taking place and to have living standards going up. And what the numbers in that spreadsheet show you is that is possible. Now, the reason why I think this is so important is that if we don't do engineer changes of this sort, we're going to have enormous amounts of stagnation on the one hand, but on the other hand, if you do make these changes, the prospects are infinitely better. And my message really to you this morning is that I think there are some ideas here which are of really very considerable significance, but they're very, very difficult to get implemented. It's very, very difficult to get politicians to go around advocating massive devaluations of the pound, although this is really what is needed to get this policy off the ground. But this doesn't mean that we're necessarily, or it's impossible to make this happen, but it does mean that a different route is going to be required. And the route really has to be to get a discussion going about what the alternatives are, and the major roles on this are likely to be played partly by the commentariat, by the newspapers, by the media, and partly by think tanks, but partly by people who are just interested in all this, who are willing to take a different view to take things forward. So my message really to you today is to have a good look at what is being proposed in this document here, to see whether you agree with it or disagree with it. And to make this easier, we've got a website which is called the Pound Campaign, or www.poundcampaign.org.uk. And on that, there is a mass of background data which has been used while this pamphlet was being produced. And there's also the spreadsheet that's in the centerpiece of this pamphlet, which you can download if you want and have a look at the numbers and change them around and see whether you can make these numbers stack up in some other way. But one of the things that this spreadsheet does show, and that's the assumptions, which actually are fairly simple ones, are way off beam, which I'm sure they're not, is that the prospects, if we carry on as we are just years and years of no increases in living standards and national decline. And it's all avoidable, and I think we ought to avoid it. That's what the pamphlet says. Now, while we're here with a bit of time, I think what might be sensible is if any of you have got any comments on this, or whether you don't think what I've said is likely to work, by all means challenge it. I think one of the most important things to do is to challenge all this, to see whether the calculations are correct, the spreadsheet formulae are right. So if you think it's wrong or you would like to press on me on any points, please do. I think there's a question there.
Hi John, I've known you for 20 years now, and you're ageless. I mean, the last time I saw you was 10 years ago and you haven't changed much at all. I have been diametrically opposed to your European policy for some years now, but having said that, I've come round to your way of thinking. So I've been converted. But I have a mischievous question to ask you. JML you've made a huge success out of, and I'm very proud of you, what you've done. You've created employment opportunities, mostly for people in the Far East. So of those products that this is a naughty question, how many of those products is actually produced in the UK?
Well, the answer is a pretty small percentage. It's around about 10 or 15%. And those are either very bulky products like pillows, which we sell, or they're very heavy products like cleaning products, which are too heavy to be worth bringing in from the Far East. Now, why don't we get these products made in the UK? Well, I'll tell you why. And that is that it's about the cost of products that we buy from China is roughly at the moment 2/3 on average of what it costs to get them made in the UK. When the pound was $2 to the pound during the 2000s, we could get goods made in China for about half what it costs to make them in Britain. Now it's about 2/3. And as long as that enormous gap's there, what you will find is that light industry, which is where productivity increases are much, much easier to secure than they are in services, will just keep on migrating to the Far East. Now, if you look at the industrial structure of this country, where we still have got quite a lot of manufacturing industry, is in arms production, it's in vehicles, it's in aerospace, it's in pharmaceuticals, and these are all industries with complicated branding, very complex supply chains, of a huge amount of experience required to run these sort of industries. But these industries in the long term are just as vulnerable to low-cost competition than the ones I used to be involved with, which are things like injection molding and metal pressing and so on, where there's no IP and relatively simple supply chains and where you can buy all the equipment on the world market. So I think that the prognosis for the UK is really very poor, not just only in the relatively light industry that is easy to copy, but in these more tricky areas as well. Sooner or later, they're going to get eroded too, unless we do something about getting us onto a more even playing field.
John, when I try and, I'm totally on side, all this. What's your answer to people who say, well, don't you believe in a free-floating pound?
Well, even if you... well, first of all, I think that the value of the pound or any currency does depend enormously on the stance of the government and what they want to achieve and what they're prepared to do about it. I mean, a really interesting case is Japan. Now, Japan doesn't have exactly the same problems as we do, but some of them are rather similar, and they've certainly been through a period for the last 20 years of the sort of stagnation, which I think is we're in danger of having in prospect for us. But they got the yen down by a third, over the last year or two. So if it's possible for them to do it, it should be possible for us. And this was done without capital controls or any of these other more drastic measures that might be taken. And if you wanted to get the pound down, what you could relatively easily do would be to increase public expenditure and reduce taxation, which would widen the balance of payments. That would certainly get the markets worried and get the pound coming down. You could get the Bank of England to have a target. You could get the Bank of England to sell pounds and buy dollars. I mean, there are lots of technical reasons why this sort of policy will work. The reason why we don't do it is because there is a widespread feeling in this country that the stronger the pound is, the better. So what we do is the reverse of all these policies, and one of the policies which we pursue that's undoubtedly pushed the value of the pound up enormously is we're incredibly good at selling off our assets, which brings vast amounts of money into the UK economy and pushes the exchange rate up. I mean, the figures in the 2000s are absolutely incredible. We sold off, I can tell you what the numbers are, between 2000 and 2010, we sold off 615 billion pounds worth of portfolio assets. Now, this is not direct investment coming into the country. That's a different number altogether. This was just selling shares in British businesses, bonds and property. Now, 615 billion pounds was about half the national income at the time. And hardly surprisingly, the pound got stronger and stronger. There was a balance of payments deficit during that period, but it was less than half the value of the assets that were sold. So one of the things we need to do is to stop selling vast amounts of property and portfolio assets to bring the pound down. The big problem is a political one, which is to persuade people that that's what needs to be done.
You mentioned Japan here, and I think I disagree with you that the way Japan got the pound down was by their fiscal stimulus. I'd say it's almost entirely based on their monetary stimulus. The Bank of Japan started printing more money and also promised higher inflation in the future. They got their inflation from minus 0.9 to over 1.6% in just less than a year. Now, you said that this wouldn't lead to inflation in the UK, but even an increase in 2.5% inflation would be a huge difference in the UK. Further to this, I also think, look, the recent past in Japan has been intensely disappointing. Whilst it did appear to work at first when Shinzo Abe increased this work for this devaluation, it hasn't been more recently. And another thing in Japan is that while they did have a 30% depreciation between 2012 and 2013, this just got it back up to where it was in 2008. Between 1998 and 2008, the yen to the pound didn't drop between $120, 120 yen to the pound. We don't have an equivalent to go back to. I'd say in Japan it was more a return to the norm rather than a new policy in itself. We haven't been at the £1.10 to the pound to the dollar that you've been looking for, apart from 1 year in 1985. And so I'd say this actually isn't really a comparison or policy to that in Japan.
Well, I think you're right in saying that the situation in Japan is not exactly the same as it is in the UK. And you're also right in saying that a lot of what was done to get the yen down was to increase the money supply. Now, there's not a huge amount of scope in the UK for increasing the money supply any further because we've increased it so much already. But that doesn't mean that the other policies that I've pursued wouldn't work. And although you say the Japanese economy hasn't done as well as everybody hoped, I think there's some truth in all that, and I'll come back to that in just a second. The counterfactual is, would it have done very much worse if nothing had been done at all? I think it almost certainly would have been. Now, one of the problems about the UK, and one of the crucial things that in this analysis, in this pamphlet here, is what is the sensitivity of demand for exports and imports if you change the prices. And I think one of the problems we've got in this country is that when the pound was $2 to the pound, it was so uneconomical to produce anything here that industrial output plummeted. When it's 250 or 260, sorry, 150 or 160 like it is at the moment, the problem is that the exchange rate is still much too high for import substitution. That is, starting to produce a lot of the goods that come in from China in the UK. to be really a practical proposition. But if it came down to something like 110, I think you'd then find that there were far, far more opportunities. So really, what this implies is that the sensitivity of export and import demand to price changes isn't a linear relationship. As you get more and more to a level which is competitive, the elasticity of demand, in technical terms, goes up. Now that's hard to prove, but it does seem logical that would be the case. But interestingly, even in this pamphlet, there are some assumptions here about what these elasticities are, and there's also some assumptions about what return you can get from investment, especially if it goes into light industry where the returns are greatest. But even if these assumptions are wrong by quite wide margins, the policy still works. You may then have to have a slightly larger or smaller devaluation. You may have to have a rather longer period before your balance of payments comes right. But the numbers still look way, way, way better than if we carry on the way we are. Yeah, Richard.
A layman's question. If you were Chancellor, you had the government's backing to put your programme into practice, what would you start by doing, and how would that affect ordinary people other than holidays abroad?
Well, the first thing I'd say is that all these policies of austerity, which we're all wedded to at the moment, are unnecessary. You don't need to have austerity like we've got. And there is no real danger in increasing public expenditure and reducing taxation, provided you can get the economy to grow fast enough. Where you are in dead trouble is if you've got rising debt, as we have at the moment, both the government and the country, but no growth. If you've got growth running at 5% per annum, you can easily afford to have a deficit, both a government deficit or a national deficit of 3 or 4%. And that's part of the trick. This is how it's possible to both increase living standards and to get these big shifts in investment to take place at the same time. So my answer to you is, yes, you do want to increase public expenditure, you do want to reduce taxation, particularly on sensitive things like VAT and national insurance. But you don't need to worry too much about the deficit, because that will correct itself. And even if it doesn't, if you've got the economy growing, you can afford to have it anyway. Yes, Roger.
Thanks, John. I certainly would like to see what you want to happen. But I've been filming over the last decades in parts of this country and abroad, where the shift has all been towards the east. And I want to do two things. One is tell you a brief story about one of them, and then to ask you a question about the banks. The first is this story. We made a film called "The Shirt Off Your Back," in which we compared the making of the same shirt to Stockport, Belgium, Hong Kong, and Sri Lanka. And the identical shirt with Egyptian cotton done on a Japanese sewing machine and the same quality of buttons. The labor cost in Stockport was 20. In Hong Kong it was about 13, and in Sri Lanka it was 7. Right? So guess what? It was, it all shifted towards Sri Lanka. And C&A, who were making them at the time, and a Dutch company, moved out of Britain after having got the grants that were being given to keep them here. Then they went to Belgium and again got a grant, an EU grant for trying to revive the economy, and then went off to Hong Kong. And that was years ago. And I wonder whether the culture has changed enough, and indeed the labor costs have come down enough, so that pattern that it's possible to imagine changing that. And then the question attached apart to that would be the banks, because the banks have been given lots of money, as it were, to invest in manufacturing, and it hasn't happened.
Well, the reason why there hasn't been any investment is because there are not very many profitable investment opportunities, particularly in manufacturing, because the cost base in this country is too high. Let me answer your question about the costs, though, on this shirt. If you look at the makeup of most manufacturing costs, you've got roughly 20% is raw materials and about 10% is depreciation of fixed assets, about 30%. All the rest are domestically incurred costs. Now, if you bring them down by a third, which is roughly what I'm suggesting we should do, this reduces your export costs, if you do the maths, by about 23%. And that's what makes us competitive with the rest of the world where we're not at the moment. Now, you talk about labour costs, and it's absolutely true that labour costs are lower in China and they're lower in lots of other places than they are here. But actually, labour costs as a proportion of manufacturing costs are typically fairly low. You know, they're 15% or something of that sort, and not sufficient by any manner of means to offset the benefits you get from getting the cost base down. Just as a typical example, I was in China not very long ago. I had to get a taxi from Guangzhou to the airport, which is about the same distance as it is from Heathrow to the UK. And that taxi cost £10. When I got back to Heathrow, I had to get a taxi to central London. That cost £70. 70. Now, that's a rather extreme example of what a very high cost base does. But the argument that you have to have low wages to be competitive internationally can't be correct. Look at Germany, look at Singapore. There are lots of countries which have got higher wages than we have by quite a margin, but still manage to be really competitive. And it's partly a question of how much investment there is, how high the productivity is in industry, but it's very, very largely an exchange rate issue, which is what you charge out all these other costs, not the raw materials and depreciation, all the other costs of the rest of the world. And if you charge them out the rate we do, you finish up by being perennially uncompetitive. That's the problem. Damon, I think you.
I just wanted to sort of broaden the argument a bit, because exchange rate has been a problem in the UK for, as you say, 20 years or more. The problem with industrial investment, and I run an industrial company, is we can't change on a sixpence or even a penny. It takes years to put in new plant and machinery today. The sort of a machinery you need to compete with low wages is highly sophisticated, which we're quite good at. But it's a year, it's 2 years to find it, install it, learn how to use it. And we haven't had a consistent pro-industrial policy in this country for forever almost. Not only is a high exchange rate, very high labour costs compared with everybody else in the world, and we have a very anti-industrial attitude towards industrial building, for instance. If you're a Japanese company coming to the country, you get a free brand new factory. If you're here already, you can't rebuild your factory because you can't depreciate it. We're losing out even to America, because America's got low fuel costs, a third of ours. Labour costs are pretty much the same, rather better educated labour force, and very cheap accommodation. So we're skewed by the currency, but we're also skewed by a general attitude that we don't like industrial companies.
Well, I think that's absolutely true, and to some extent what you have to do is to offset that by having an exchange rate that kind of makes allowances for all this. I mean, what is true is that all the evidence shows that to switch over to having more industrial output, more exports, doesn't happen overnight. All the figures produced by the IMF, which are quoted in that pamphlet there, suggest that it takes 2 or 3 years for this to happen for exactly the reasons that you've just described. And what also is the case is that the initial effect of a devaluation is to make the balance of payments and everything worse, because you get more imports coming in to partly for industrial investment. It takes time for the export side of it all to improve. So that's all true. But I mean, if you say, what should we do about this? I mean, I think to throw your hands up in despair and say there's nothing we can do, which I know you don't do, it's just the reverse of what needs to be done. We've got a more difficult problem to attack than other people have, because I agree with you, the culture in this country is very anti-manufacturing in particular. And what is really interesting, if you look back in the history over the last couple of 100 years, was how quickly the early entrepreneurs in the 19th century shifted away from being interested in manufacturing and put their money into palatial houses and all this sort of thing, and how quickly the culture in favour of manufacturing disappeared, and people saw their careers as being in the civil service or building the empire or being in the military or the church or something, anything except manufacturing. And one of the interesting things about the UK economy now is how many senior executives aren't British born at all. And I think part of the reason for this is that the number of really able people who have gone into manufacturing over the last decades is lamentably small. Of all the people I was at university with, none of them went into manufacturing. They all went into something else. And if you then finish up with cohorts of people in manufacturing who really aren't very bright, you finish up with a huge competitive problem compared to what happens in places like China, where the most able people go into manufacturing. And that's really a huge culture change which we need to alter. But the only way you're going to do this is by making manufacturing more profitable. Just telling everybody they ought to go into manufacturing when they can't make any money there is never going to work. Yes, Michael.
What was, yeah, excuse me, I can't remember. I remember Harold Wilson devaluing in '69. Was there a good positive outcome from that? I can't remember.
Well, there have been various devaluations since the war. There was the 1949 one, which did improve the situation, but rather got swamped by the Korean War, which came in shortly afterwards. There was the 1967 devaluation, which did improve the situation, although the pound was really very overvalued by then. It came down from 280 to 240, which wasn't really enough. A really interesting case is 1992, where the pound came down by quite a lot, nearly 20%. And what did happen as a result of that were two interesting things. First of all, you may remember John Major making speeches just before he came out of the ERM in 1992, saying the world was going to come to an end if we didn't stay in, and that inflation would romp away and the British economy would be in a disastrous state. What actually happened was that inflation went down quite significantly after 1992. And so the argument that you always get more inflation if you have a devaluation was certainly disproven by those results. The second thing was that whereas during the 1980s, British industry as a percentage of GDP had plummeted down, during the 1990s, with a lower pound, it did stabilise. It then plunged down again when we got to the 2000s, when the exchange rate went way up again. So there's a really very strong correlation between the percentage of GDP come from manufacturing and the fluctuations in the exchange rate that we've had. Yes.
I've got a couple of questions. I guess, I mean, actually, they tie in kind of quite closely to what you were just talking about. The first is the kind of the institutional thing. So I guess the history of exchange rate targeting in the UK is an extremely checkered past. So traditionally, in, I don't know, 67, 92, whenever that the exchange rate was targeted, the macroeconomic consequences for inflation, unemployment growth, or whatever, were absolutely disastrous. And since basically we now have a Bank of England targeting inflation, I think we can agree that probably outcomes, at least in terms of these broad variables, have been a bit better. So I was curious about what this proposal would do for basically the Bank of England's mandate. Is my first question, but I also had a second one, and this is, I just to kind of hopefully disagree slightly and hopefully not too much. I question whether or not I think you've got 30%, a large devaluation of the pound would do anything at all. So there seems to be this thinking that the pound is currently overvalued, but it did fall by 25% between 2008 and 2009, and absolutely nothing happened, and absolutely nothing has happened to this day. I mean, you cited Japan. Japan, I think the yen fell by something like 30%, and in fact the trade balance deteriorated. I think, and I obviously stand to be corrected, the balance of evidence of large devaluations in currencies across the course of the last 80 years or so across most OECD countries is quite mixed. And certainly the recent experience of both Britain and Japan actually says that it might not have that much effect. So I was wondering if you could comment.
Okay, let me try and pick up all those points. First of all, is 2% inflation the right primary economic target? I don't think it is for one really, really major reason, and that is it's very, very difficult to combine any reasonable growth rate with a 2% inflation rate. It just doesn't happen. And the main reason for this is because you get very uneven increases in productivity if you have a higher growth rate. And you then get a sort of evening out effect that takes place called leading sector inflation. And if you look, for example, at what happened in Western Europe between 1945 and 1970, when there was a kind of golden period and growth rates were running at about 4% per annum on average right across the piece, inflation was running at about 3 or 4%. And there's no evidence anywhere of inflation running at 2% and reasonably high rates of growth taking place. On your question about whether having a low value of the pound produces better outcomes, I think there are two really major points to make. One is that in the short term it probably won't, and this is partly what's happened in Japan and what happens in other places, and that's again, those who are familiar with economics, it's a J-curve effect. It takes longer for exports to respond than it does imports. And so you get a deterioration before things improve. But if you think that having a lower exchange rate doesn't make any difference at all, this is a complete contradiction for all the evidence there is about elasticities of demand for imports and exports. Now, if you look at the website that we've got, there's summaries there of two really major exercises that were done. They were meta exercises. In other words, they were averaging out lots and lots of different studies done by lots of different people. And one was done by some academics in the late 20th century, and the IMF one, which was published in 2010, was related to the early 2000s. And what these show really conclusively is that the elasticities of demand are in the right place over a 3-year period, not over a 1-year period, but over a 3-year period to produce the improvement that you need. And unless you believe that, for example, the best solution for Greece, if it comes out of the euro, is to put the drachma higher and higher and higher, which I'm sure you don't. I mean, all the obvious conclusions you have to draw is that the cheaper the price that you charge in the rest of the world is, the more likely you are to sell successfully. And that's what history does show. There are time lags, there are other factors that come into play. But I think the big mistake that's been made in this country is to think that there are only two really major ways in which you can control what the economy does. One is fiscal policy, which is taxation and expenditure. One is monetary policy, which is interest rates and the money supply. The third one is the exchange rate policy that you want to pursue. And really what you need to do is to pursue all three of those policies in tandem, and you get it right. If you don't believe that exchange rate policies make a difference, look at China. China has held the yuan down consistently over the last few years. That's why their exports have expanded and expanded. That's why it's so much cheaper to produce in China than it is in the UK.
John, could I come back to how we're going to sell our programme on the assumption most people are convinced that you've got the answer? Very shortly, the bank rate will have to rise. It's ridiculously low level. At that point, our servicing costs to meet our huge overseas borrowings will exceed the amount of money we're actually spending on defence. People begin to get worried, and how will we meet those servicing costs? So it may be that the work we're doing now is building up to be ready to answer the problem when that crisis hits us, which it probably will in about 2 years' time when interest rates rise.
Well, I mean, a lot of the servicing costs we've got at the moment are with bonds and so on, which have got fixed interest, so that won't be an immediate problem on its own. But I mean, I think you're right. I think that interest rates at 0.5% over the long term are just unsustainable. I mean, what you really need to get the economy reasonably well balanced between savers and borrowers, and between investors and people who put up the money, is to have interest rates that are probably 3 or 4%, something of that sort. But the problem we've got is that it's impossible to get there from where we are now, because the other side of it all, the exchange rate side of the policies that we pursue, are all over the place. And so I think the pressure on the whole world, or the whole of the Western world, to keep interest rates down, which we've seen over the last few years, is going to be quite difficult to resist. I think you're probably going to see interest rates creeping up a little bit. But if you adopted the sort of policies that we're talking about here, with a much lower exchange rate and allow 2 or 3 years for it all to work through, I think you could then relatively easily afford to have interest rates coming back to more sensible levels, and that ought to be part of the policy mix that ought to be pursued. Yes?
Just on the point, quickly on the point of China, I think it was a bit of an unfair point, considering, my name's Babs, by the way, considering that there are a lot more political, some would say somewhat more political reasons than economic reasons why China's labour costs remain down, and some would probably say more brutal reasons. But coming back to Mr. Hazel's point on the 30% devaluation, looking at it from a foreign policy angle, we have the issue that the presumption is that several competitors also won't try and devaluate, and that's what many people from a foreign policy standpoint would say has happened in the past few years, why the economy, when there has been a 25% devaluation, it hasn't seen the reaction that you were currently proposing there would currently be. merely because several competitors around the world have also attempted to devaluate against the dollar. So I just want to ask, what do you think our competitors would actually do in the instance where we devaluated the pound by, let's say, around 30% in the next few years? How do you think they would possibly respond? And don't you think that that response could possibly affect the way the British economy grows in this paper? And I think this paper seems to miss that out. It sort of assumes that competitors won't do anything and that we're operating within a bubble.
Well, let me give you an answer to that question. Of the major currency areas which might respond, you've got the United States, which is in great difficulty about doing anything because it's a major reserve currency in the world. So they're not in a position to do very much. You've got the euro, which has got many other preoccupations apart from that, and is structurally in a very difficult position to implement any sort of counteractive policy to what we do. Then you've got the Far East, where really we're just a sort of a small dot on their horizon. I mean, our share of world trade now is barely 2.5%. So what happens to China or Indonesia or Taiwan if we devalue really doesn't make a huge amount of difference to them. And when the pound came down from $2 to the pound to 1.43, I think was the figure it dropped to at one stage, the Pacific Rim didn't blink, and nor did the euro, and nor did the US dollar. So why there should be any huge difference if it comes down much further, I don't know. Sorry, I need to come back to your point about whether coming down from $2 to the pound to 1.60 made any difference. There's a widespread feeling that actually our exports stagnated. They didn't. The exports actually went up quite substantially over that period. They went up by about 15% in value and about 28% or something, by value, and about 15% in real terms. Unfortunately, what happened at the same time as imports rose as well. But this is partly a problem of the economy being so uncompetitive still, even at 160, that actually you don't get the response from exports that you really need. If you had a lower currency or lower value for the currency, then you'd get a much bigger response because it then becomes economical to produce far wider range of products in the UK rather than elsewhere. So I don't think the retaliation point is a really very heavy point at all, to be honest with you. And also particularly if what we then do is to go on running a balance of payments deficit, which I think we should do, you're then not acting in a predatory way on the rest of the world. You're importing more goods from other people because your balance of payments is in deficit. I mean, why should they retaliate? Yes, over there.
So, Matthew Holness from the Daily Telegraph. You've been a long-standing supporter of the Labour Party, obviously very involved as well with the People's Pledge. Were you surprised or disappointed to see that the Labour Party appeared to have ruled out a referendum on membership of the European Union for the time being? And are you confident that the Labour Party is seen as being on the side of business and understanding the concerns of business at the moment?
Well, I have to say that I've got two rather separate caps on here, one to do with the EU and referendums and the other one to do with the exchange rate. Yes, I mean, I think there are arguments for having a referendum that are quite compelling. I think we need to make up our minds whether we're going to make a go of the European Union or not. I think if we are going to have any renegotiation, having a referendum at the end of it all must increase the prospects of making that renegotiation successful. And for what it's worth, I think most people in this country would prefer to stay in the European Union if we could get the terms changed to ones that took us more back to where we thought we were when we joined in 1973. So that's my view on the referendum. Sorry, your second question was?
Are you confident that the business community is confident that the Labour Party understands the need of business on the side of business?
Well, I think that Ed Miliband's been very successful in kind of homing in on concerns people have had about living standards, concerns about the way bankers have behaved, concerns about what energy companies have done. And I think that the result does look as though it's a bit less sympathetic towards business than perhaps most people in this country would like. I think this is counterbalanced, though, by other parts of the Labour Party, particularly Chuka Umunna, who's been, I think, very successful in courting British business. And I think the reality is that any government can't afford to alienate the business community. and I don't think the Labour Party would do that if it was in power. I think there's a certain amount of rhetoric going on at the moment which wouldn't be mirrored by what would actually happen if the Labour Party was in government. Yeah, Peter.
I just want to pick up your point you made about needing a higher rate of inflation, and particularly the comment you just mentioned here that there's no examples of economies with a 2% inflation rate and growing. I mean, you yourself emailed me the other day that the growth figures for China and Singapore over the last decade, and in the growths are like 10% on average and 6% per annum, and yet the inflation rates were just 2%. And add to that if you go back to Victorian times, we lived through a great period of economic growth. We actually had deflation. Prices went down by about a quarter over about half a century. So you don't have to be linked. And I think that particular period which you've used to create your argument from post-war, there were other things going on. We all had massive debts, OECD countries, and they were keen to get inflation rate up to reduce those. So I'm not sure that we should argue now for a higher inflation rate. Or if you are, what is the reason for that? Because I'm not sure it's the one that you've given me.
Well, I think in the 19th century, there was deflation in the last quarter of the 19th century. That's absolutely right. But that was not a golden period for British manufacturing or growth in the economy. The growth in the economy slowed right down when that period.
I think GDP went up, doubled or whatever.
It was increasing, but it increased more slowly than it had done previously. But if you look at I mean, there were other factors in place there. We were in the gold standard. There were fluctuations in the amount of gold that was being produced. I mean, there were all sorts of technical reasons why the situation was a bit different. But if you look at all post-war experience, I think you'll find no country with a growth rate of 4, let alone 10%, which has an inflation rate of 2%. I mean, that's not happened in China. It certainly happened in Singapore.
Those are the figures you sent me and attached me to that email last week.
But the average was way above 2% in both cases. I think we're probably coming towards the end now, but maybe take another couple of questions. That's work out right? Yes, there.
Michael Butcheka from Young Enterprise. Thank you, John. A really interesting talk and a great Q&A. So if you are successful in this campaign and it all works out, do you see that foreign companies, extreme example, the Chinese would move here and build factories? Or do you think that this malaise against manufacturing attitude in this country, can we get this country to get back into manufacturing, English companies to do that? Or, because then obviously jobs would be created, but all the profits would go abroad. Do you see that as a problem or not? And can we get this country back to manufacturing in terms of British companies doing that?
Well, I think you get some British companies to do that, and there are, people on the whole will do things that make money. And it's not actually, a lot of manufacturing is not all that complicated and difficult to do. I think what is the case is that most manufacturing you're left with in the UK is very complicated now, because that's about the only way you can survive. But most of the manufacturing that involved, I mean, I used to run years ago injection molding operation. And we had employed, 50 people or something. There were 2 of us who knew how to set the machines. Everybody else was unskilled, doing assembly work, machine handling and all this kind of thing. The skilled work was in setting the machines. Everybody else was unskilled. And with a vast swathe of manufacturing, this is the case. You can actually get people trained up to do a job in a very short period of time. What you do need are some leaders. You need some people who really have got the technical knowledge to be able to get the machinery to operate properly. And I think we are short of people like that in the UK. Although whether we're so short that we couldn't get an industrial revival, I don't know. I mean, if you look back, the 1930s is a very interesting period, because during the 1920s, Britain suffered from very much the same sort of malaise as we've got now. There was a huge devaluation in 1931, about 30%. And what then happened was the British economy had the fastest rate of growth in the mid-1930s it's ever had before or since. And what happened quite quickly was that people did materialise. The growth rate went up to about 4% between 1932 and 1937. There was a huge wave of industrial investment, which was sufficient actually more or less to carry us through the war. If this hadn't happened, we would have been in much worse shape in 1940. there was an enormous increase in industrial employment, and it all happened over a relatively short period of time. Similar to what happened, again, the figures are in that pamphlet there, what happened to the United States at the end of the 1930s. The 1930s had seen high levels of unemployment, pretty poor levels of economic growth. And suddenly when Lend-Lease came in, slightly different stimulus, the American economy expanded at incredible speed. It grew by over 70% in 5 years. 70% as a result of a massive wave of investment in war production and huge increases in employment in industry. So there are loads of examples all over the world of this sort of trend happening. Just finally on the question about foreigners coming in to do it, I mean, I think there's all the difference in the world between direct investment from abroad in factories and machinery and buying portfolio assets. Now, I think that we should encourage direct investment if it's in factories and machinery, but we should strongly discourage it if it's just buying existing portfolio assets, which do absolutely nothing to improve the British economic performance at all.
So, I'd like to just actually...
So, I think there's one question over there.
Two very quick ones. The last question, if I'm not mistaken, started his question by saying, if you're successful. Can you briefly, in 60 seconds, define what you will consider to be successful and what impact it could possibly realistically have by the date of the next election? And secondly, a few of your answers have actually very much not just been about figures, but about a context, a historical one, a socio-economic and a social one. How can you compare the 1930s with the climate that exists on all of those, in all those sectors in this country today?
Well, to take your second question first, I'm not sure the situation in the 1930s is so different from what it is now. I mean, obviously, 1930s was 80 years ago, whatever it was. The social context of the country was very different. But the economic stimuli and the responses to it, I don't think were that different. And I think you've seen the same sort of thing happening much more recently in countries which have industrialized very rapidly over the war, with the same combination of lots of light industry investment and people being drawn in from either unemployment or underemployment or from farm economies. And there are examples all over the world of economic stimuli working. But on your first question about what would be success, I mean, I think success would be getting a really serious discussion going about whether it really makes sense to run the British economy the way we have been for the last, I don't know, 4 decades, but actually for much longer than that. Whether it really makes sense just to rely on fiscal policy and monetary policy completely to neglect what is in fact an even more important metric in terms of running the economy, which is the exchange rate. Whether it really matters that we're terribly uncompetitive, whether it really is acceptable that we're going to go into maybe a decade of no growth at all. And let me just come back to one point I made earlier on, which is that the sort of austerity we've got at the moment isn't all that bad for people like us in this room here. But it's terrible for maybe 2/3 or 3/4 of the people in this country who are really suffering from declining incomes, who are in jobs which are very insecure, which are, or in many cases, people are unemployed. There's a staggering figure, just to give you this one more figure. If you take the registered unemployed, it's about 2.4 million at the moment. If you take the total number of people between 16 and 65 in working age who are not working, it's about 3 times that number. It's an enormously high figure. So there are enormous gains to be made by running the economy more efficiently. And I think we really need a debate around the sort of concepts there are in this pamphlet as to how this could be done.